This is why ASML is still one of my largest positions in my portfolio today. So in today's video, I'll be covering two portions. We'll be covering why I'm bullish on ASML with caution, as well as some questions left in the comment section below. So let's talk about my portfolio. My second largest holding is ASML. It makes up around 9% of my entire portfolio. So for ASML, the stock is up around 17% year to date. It is currently trading at $811 a share and down around 25% from its all-time highs. So for ASML, this is their business model. They have their net system sales where they sell your lithography machines, and then they have their installed base portion, which is their recurring revenue that comes in every single month, where they have ASML personnel stationed at all these different machines to provide maintenance and service for the machines. So for ASML, majority of their revenue still comes from the DUV portion. The EUV portion only makes up around 30% of the entire revenue share. The machines that they sell look something like this in the inside. So what happens is there'll be laser being shot at a tin, which creates plasma, which will basically pattern all your different wafers to create your semiconductor. So for ASML, this is the first bear thesis for the company. It is the China EUV lithography creation. So China has been pushing very hard to create their own EUV machines because they want to reduce their reliance. And currently they can't get the EUV machines from ASML as well because of a ban that was placed on them by the Netherlands government, likely being influenced by the US government as well. So for the Chinese, they've successfully created a laser-driven plasma technology in their EUV machine. As compared to ASML laser-produced plasma, the LDP is actually a lot higher in terms of cost and lower in terms of the power output. So this is likely all experimental at this stage. Other companies like KLAC, they're exploring this as well, but so far they've all been for experimental purposes. But China is definitely pushing hard in terms of their EUV machines, but by then hopefully ASML will still be ahead of the Chinese. The next bear thesis is simply just your China concentration. So China currently makes up around 27% of their total revenue, and if we see export restrictions being placed on ASML in the future, this could negatively implicate their revenues. And for ASML, there's always the cyclicality that is associated with your semiconductor industry. So this is the net income from ASML over the years, and it's sort of like a wave up and wave down and wave up and wave down, but the long-term trend has been up. So as long as you can ride the volatility with this stock as well as the volatility in earnings, it should be okay in the very long term. So for ASML, there are also some competitors to your EUV. So the first technique is stacking, but stacking increases the cost and raises thermal issues, and it is seen as more of a last resort as compared to a replacement for your EUV. The other one is quantum computing. We will unlikely see this over the next 20 years, so I don't think this will be a substantial competition to ASML. The next risk that people often associate ASML with is the customer concentration risk. So they have more than 50% of their revenues coming in from three players: Intel, Samsung, as well as TSMC. So the argument that the bears make is that if one of these companies, they massively reduce their capex, then this could negatively implicate ASML's earnings. But you might want to think of it this way: all these three companies, they're competing against each other. So when one falls behind, the other companies will want to get ahead and stay ahead in the semiconductor industry. So when a company like, for example, Intel reduces their capex, then another company in the form of TSMC will likely take over their capex spend and buy over the lithography machine that Intel didn't want to pay for. The other risk associated with the company is your AI bubble. So mature wafers don't use EUV. Those make up around 70% of the wafers today. So there could be a risk of saturation there. So only your advanced chips, they require EUV, those that are required for AI, cloud compute, smartphones, AVs. So if there's an AI pop, then the demand for your AI chips and your cloud computing chips will slow, which will negatively hurt ASML's earnings. So for ASML, this is probably one of the riskier positions that I have in my entire portfolio. China definitely has the capability to create their own machine, and it's not an if, but when. They will eventually come out with it, like what they've been doing over the past 20 years, constantly catching up to the US and maybe even surpassing the US. The AI bubble will not cripple the company, however. Only 35% of their EUV is tied to AI and cloud computing, so the company will fall 10 to 20% in terms of the revenue over the next few years if the AI pop actually happens, and I'm willing to ride that volatility. So for ASML, here are some of the bull theses when it comes to the company. So first of all, ASML is a complete monopoly in your lithography space. So they hold 100% market share of your EUV space. They hold around 80 to 90% of the DUV space. So this is the only company in this entire list over here that holds a very dominant share in the most important component of your entire wafer fab equipment portion, which is patterning. And that's why ASML is probably the most predictable company out of all these different companies here. And for ASML, they have incredible pricing power as well. So because they're the only company that is able to sell your EV machines, they have the ability to price their machines at any given price. And over the past 5 years, ASML has actually increased their lithography machines prices by 50% or so. So that is a CAGR of around 7 to 8%. So when a company can increase the prices by 7 to 8% every single year, beating inflation, then that means that their earnings will grow a lot faster than just 7 to 8%, because every dollar increase in the pricing itself is 100% net income for the company if fixed costs stay the same. So for ASML, this is another bull thesis for the company. So with Trump being in office right now, he's trying to bring all the AI fabs into the US, and that is why we're seeing an increase in your fabs in the US itself. So for example, this is TSMC Arizona fab, and when you see more fabs being built, it leads to more lithography demand, which means more income for ASML as well. We're coming out of a downturn. So we had a downturn in 2023 in terms of your semiconductor industry. And apart from AI, the entire semiconductor industry was undergoing a downturn in 2023. It's a cyclical downturn. So over the next few years, if we can see the recovery coming into play, then this could beat up ASML's earnings as well. The next wonderful portion about the business is that growing installed base and the recurring revenues coming in every single year. So for ASML, the company, they sell the machines, and the machines last up to around 30 years. In fact, they last more than 30 years, and that is 30 years of 100% retention rate of recurring revenues coming into the company every single year. So over the next 5 years, the company is projecting around 13% CAGR in terms of your installed base management portion of the business. So this is a highly predictable stream of revenue that can come in every single year. In fact, all your high quality businesses like GE, like all your different defense companies, they have this installed base portion because it is highly predictable stream of income coming into the company. And if ASML can sell more machines, it will lead to even more installed base revenue coming in every single year. This is their guidance for 2030. So they're projecting around $44 to $60 billion of net sales, and they're projecting between 56% and 60% gross margin. So they're expecting increase in the gross margin of the company, as well as an increase in the total sales. And this is my valuation for the company. So for ASML, assuming a 30 times multiple for this company, I think this company deserves the multiple because it is a monopoly in the space. And for ASML, assuming a 11% EPS growth, which is the middle case assumption from here on out all the way until 2030, this company will give you around a 10% return, which means that the company is around fair value also. But if you're to bump this up to around 15%, which is more than achievable given the AI cycle, this company's CAGR over the next 5 years can be up to around 14%. And if we give an even more bullish assumption of the PE normalizing to around the mean value, which is around 35 times, this company will give you an 18% CAGR over the next 5 years. So for ASML, it is a company that is the backbone of AI and likely one of the more predictable companies in AI with zero competitors. I think the company is currently trading at around fair value or so. The earnings are coming up tomorrow, so we have to see how that one plays out. The net bookings number will be the number that Wall Street pays attention to. I think the China risk is not to be ignored, but it will take years for China to have a better yield, lower costs, and force everyone to switch. So imagine all these different fabs, they're all built on ASML machines already, and forcing them to switch to China lithography machines will be extremely hard. So it will take a lot of years for China to implement the EUV machines, and in the meantime, ASML will still be able to hold its monopoly. And that's why I'm bullish on this company, and it is my second largest holding in my entire portfolio. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, great video yet again. Thoughts on Nasdaq, London Stock Exchange, and Euronext stock. So Chris Hone has previously invested in Deutsche Börse Stock Exchange, White Moat, high barriers to entry, and predictable revenue. So all these different stock exchanges, they're sort of like toll booth businesses. They're incredibly predictable and incredibly high margin businesses. All these businesses, all your stock exchanges, they're extremely predictable and high quality businesses. But the problem with them is simply just the valuation itself. And you have to ride the downturn in terms of the earnings of the company, especially when a bear market comes. But overall, I think these companies are high quality businesses and they're definitely on my watch list as well. The next comment, it says, thoughts on Disney. So Disney is a legacy company that's been around for a very long time. And over the past 20 years, Disney has actually returned almost zero returns for its shareholders. And this is what Warren Buffett has said previously about the streaming market as well. So Warren Buffett in 2023 made headlines with his candid remarks about the streaming industry. He stated during an interview that streaming was not a very good business for investors over time. This sentiment was reflected in the market performance of major media companies like Comcast, Disney, Paramount, and Warner Brothers Discovery. So all these different legacy businesses are being taken over by companies like Netflix, like YouTube coming out with their streaming services. If you're looking for a streaming company, I think a better alternative would be to just invest in Google. So for Disney, it is an avoid for me. The company is not predictable enough. It is facing a lot of competition in all these different spaces, and that's why I'll be avoiding this stock. I hope you guys have found this one useful and invest safe.